everyone, I am Smriti Bhatia, analyst of Forex Risk Advisory at Myforexeye. Today, I am going to share with you the technical analysis studies used by Myforexeye for forecasting and framing directional view. Here, we are going to discuss about price patterns. Many market participants buy and sell currencies for a wide variety of reasons. Price patterns help to bring that buying and selling into a perspective by consolidating the forces of demand and supply into a concise picture. Price patterns are hence used for making short-term and long-term forecasts. The price pattern analysis is built on the assumption that price is trend. Hence, trend lines are very important in making forecasts. There are two kinds of trend lines: support and resistance. A trend line is basically a straight line that connects two or more price levels and then extends into the future, thus indicating the future trend. A support line is the price level at which the demand is so strong that it prevents the price from falling further, while resistance is the trend line that tells the price level at which the selling is so strong that it prevents the price level from rising further. Today we will discuss about the seven price patterns: double top, double bottom, triple top, triple bottom, head and shoulders and inverse head and shoulders, rising and falling wedge, three types of triangles, bullish and bearish channels, and flags and pennants. Let's start with double top, double bottom. So double top and double bottom patterns are basically trend reversal patterns. In a rising trend, when the price forms two peaks which are roughly the same, roughly at the same level, then we form a resistance line here. And the lowest point between the two peaks is known as the neckline or the support level. This trend is confirmed once the price breaks down below the neckline and we say that the trend has reversed. Similarly, in a double bottom pattern, the price is in a falling trend and the price levels form two lows which are roughly the same. This is the support then. The highs between the two lows is known as the neckline and the resistance line. Once the price breaks above this resistance line, we are confirmed that the trend has changed and it is a bullish trend now. Triple top, triple bottom is roughly the same as double top and double bottom. The only difference is that in triple tops, three tops are formed. As you can see that the price is in an uptrend and here three peaks are formed. The lows between the peaks is known as form the neckline. Once the price falls below the neckline, the pattern is confirmed and we see that the trend has reversed and it is now a bearish trend. Similarly, in a triple bottom, it is in a downtrend and the price forms three lows. The peak between the three lows forms a neckline. Once the price rises above the neckline, we confirm the pattern and say that the trend has reversed and it is an uptrend now. Head and shoulders. This is very interesting. Head and shoulders is also a trend reversal pattern. Here, the price forms three successive peaks, but the only difference is that the middle peak is the highest, which is the head, and the outer peaks are roughly the same level and are known as shoulders. The reaction lows form the neckline, and once the price breaks down the neckline, the pattern is confirmed and we say that the trend has reversed. In inverse head and shoulders, the price is in a downtrend. The lowest peak in the middle is known as the head and the outer lows, which are roughly the same, are known as the shoulders. Once the price rises above the neckline formed here between the by the highs between the lows, then we say that the trend is confirmed and it is a bullish trend now. Wedges. We have rising wedge and we have falling wedge. As you can see, the wedge is formed by consolidation of the price action. This basically shows a bit of inactivity in the among the traders. A rising wedge pattern has a tendency to break below the support line. Once it breaks below the support line, the prices are more likely to fall further. In a falling wedge, the price has a tendency to break above the resistance line. Sorry. Once the price breaks above the resistance line, it is more likely to extend further and is bullish. Channels. Channels is basically formed when the price moves in one direction, in one momentum, and is basically in a fixed range. As you can see, there are two types of channels, bearish channel and bullish channel. A downtrend channel is known as bearish channel and an uptrend channel is known as a bullish channel. This is known as the main trend line here, and in bullish channel, this is the main trend line. The other line is the channel line here. The upper trend line is the resistance and the lower trend line is support. Here the resistance is this line and support is here. For a bearish channel, the main trend extends down, and for a bullish channel, the main trend extends up. Well, price channels do not last forever, but the underlying trend, that is downtrend or uptrend, remains in place until the support or resistance is breached. Then we have triangles. Triangles form as price consolidate. This, when the price is moving sideways is known as consolidation. It falls under the triangles fall under the category of continuation patterns. They are basically horizontal trading patterns, that is, they move sideways. At the start of the formation of a triangle, it is the widest point and then it goes narrow. It narrows further. Triangle shows losing interest in an issue from both buy and sell side. First, let's discuss about symmetrical triangles. Also referred to as coil, it is a continuation pattern. Triangles mark important trend reversals. They often mark they often mark a continuation in a trend. So it might be a continuation pattern, it might be a reversal pattern. Direction of the next major move can only be determined after a major breakout. That is, a breakout above the resistance or a breakout below the support. The other two types of triangles are ascending and descending triangles. As you can see that if the price forms highs which are roughly the same level forming a horizontal resistance and a rising support, it is known as an ascending triangle. The lower trend line is rising and the upper trend line is horizontal. These are reversed. The reversal takes place once the support breaks. In a descending triangle, the lows are roughly the same level and the highs are reducing. Thus, the lower trend line is horizontal and the upper trend line is downward sloping. The reversal takes place here once the resistance breaks. This is how we analyze triangles. Last, we have flags and pennants. Flags are rectangular patterns. The slope of the flag is usually against the trend. As you can see here, the price is in an uptrend, but the slope of the flag is in downtrend. If the previous move was up here, like here, the flag slopes down. If the previous move had been downtrend, then the flag would have been upwards. This pattern is basically a continuation pattern. Once, like here, you can see that if the price it breaks above the resistance of the flag, it continues upwards. Similarly, we have pennants. Pennants are also continuation pattern. The only difference is that pennants are in the form of a triangle, a symmetrical triangle. It begins wide and converges as the pattern matures. The slope of the pennant is usually neutral, not very steep, and it is a continuation pattern. Once the support of the pennant breaks, the trend continues further. This is all for you for this is all we have today. Thank you so much for being here. I hope you understood how we analyze and make directional views. If you have any further queries, feel free to connect to us through research@myforexeye.com. You can also contact us on 7771 009 009. Thank you.